So I have a saying, think like a retail trader, but do not trade like a retail trader. And in this video, I want to go over why 90% of these traders fail using standard technical analysis. A lot of retail traders don't understand that we are small fish in a big sea, and a lot of smart money, big traders need our money, they need our orders, and they need our liquidity for their orders to get filled and for the patient, smart money traders to win and us retail traders with a small amount of money to lose. So I want to go over what to look for, what to do right, what to do wrong. I'm going to break down actual trading charts, go over some actual examples so you all could visually see what I'm explaining better so you don't make these same mistakes and you could set yourself up to win and not lose using standard technical analysis. So us retail traders provide liquidity for smart money. They need our orders, they need our stop losses, they need to know when we're buying or selling so they could be on the opposite side, gaining our liquidity and filled their position. Smart money needs our retail traders' liquidity. To validate this point even further, I recommend everyone to follow me on my Instagram at Ameritrade. I'm going to post a link in the description below. This is my only account. A while back, I posted about how banks manipulate retail traders. When traders are getting stopped out, those are buy positions. You have a lot of breakout buyers, more buyers, and then the market dumps. And where the majority of retail traders would get into a position, the market moves reverses from it, and these retail traders lose while other smart money is on the other side buying the market when everybody else is stopping out. 95% of retail traders do not make it in trading. Retail traders are easy manipulated, so it's very important to buy when others are selling and sell when others are buying. Understand that we can trade on the same side as these smart traders, big banks, or anybody that manipulates retail traders. Learn the system and put yourself in their shoes and trade on their side. Look at this chart right here and be honest. What does this chart tell you? This is the S&P 500. We're uptrending, putting in higher highs. The market opens up. We have strong volume out of the gate and we get a strong, quick little opening push to the upside. Now, if I'm looking at this chart completely naked with no other external factors, this chart looks extremely bullish to me. So a lot of traders, what they're going to say is they're going to get in the market long at this oval right here. Then the market's going to pull back. Maybe some of these traders stop out. Maybe they're still in this position. And then the market breaks out again. Nice buying volume to come in. We break the high a day. And a lot of other breakout traders get long the market when we break the previous high. Then we have a nice little consolidation candle, and then the market starts dipping down. This chart still looks very bullish, and it's safe to say that this chart induced a lot of retail trader longs to enter the market and buy a bullish position here at the highs. Now, we add a supply zone to this chart, which not a lot of retail traders know, they don't understand, and a big rule of thumb is to not long the market in specific downtrending markets when we are at a supply zone. Now, a lot of people, if you don't know supply, you're just going to see the market rally. You're going to see us break the high, and you're going to get in long, not realizing we were in a side of a supply zone. This chart to me right now, with the context of us hitting a supply zone, is not bullish. And in fact, me using the basis that I know a lot of retail traders are going to be getting in the market long up here inside of a supply zone sets us up for a perfect recipe for the market to reverse, build liquidity for retail traders to get long, or just other breakout traders. It doesn't have to be retail to get long up here near the highs. A lot of traders are in long as volume starts to increase and the market absolutely dumps from this supply zone. A lot of traders stop out, and this is a perfect recipe for a reversal. Where majority of retail traders are buying, look at ways you could sell, and where a lot of retail traders are selling, look at ways to buy. When you add the context of a supply or demand zone, this is a perfect recipe of a market reversal, especially when retail traders are bullish or bearish on one side of the market. Now, how about this chart on Tesla? We're putting in lower lows, we're putting in lower highs. This chart does look very, very bearish. A lot of traders, what they're going to do is they're going to mark out a support zone in this area right here. And they say, okay, the market's going to break this support zone. I'm going to play short. I'm bearish as soon as this level breaks. And the market is going to keep heading lower. Support resistance, I still use it in my trading. I'm not against it. However, it is very old school, early 2000s, where support and resistance was very easy to do. The barrier of entry was very difficult, and a lot of people were making money with it. It's very simple. All we can do is mark out a bunch of lines on our charts, call them support and resistance, and play the market long or short if we break below it. It's very old school, and it's not as reliable as everybody else to this day still does it. And when you have other traders knowing where others are buying and selling and when others are stopping out, this is a perfect recipe for the market to reverse. In this example, Tesla, where we have this low, we break below it. A lot of traders are most likely getting short on the break of this low, not realizing we were inside of a demand zone, indicates a potential reversal to the upside as long as volume increase. And it's safe to say a lot of retail traders were getting short on this move, and then Tesla reverses to the upside, not knowing that we have a demand zone and knowing that a lot of traders are getting short below a low at daybreak. A lot of traders do not understand market structure and market context, and this is vital because a lot of traders treat every single day the same without putting any factor to the context or the structure that we are seeing in the market. And again, on the S&P 500, it's safe to say off of this 15-minute chart that the market is extremely balanced. How do we know it's balanced? Well, we're contained in a very tight range where the upper boundary is this white line and the lower boundary is this lower white line. And throughout the overnight session and then the following day session, we were contained in this very, very tight range. So what this tells me is we had demand in this area right over here that the market sold off into and rallied in the morning session, and we actually took the market long off of this demand zone. However, with the structure in the market, we know we are balanced, and in balanced rules, the market will never make a strong continuation move when the market is contained in a tight range. Tight ranges and market balance means participants are agreeing on price. Buyers and sellers are in equilibrium. This is where context comes into the picture. You want to trade when buyers have the upper advantage over sellers or when sellers have the upper advantage over buyers. In this example, the market is balanced. Yes, we bounced off of this demand zone. However, I was mentioning on voice chat that no large move will come if we are still contained in this tight little range right here, despite us bouncing off of this demand zone. So context is important because what's going to happen is you're going to see a lot of traders that get long the market off of this demand zone, right? And they're going to set a further out target, maybe something near the highs. So they get the market long off demand, great entry, but their target was so far away because they were not aware of the context in the market, indicating that conditions do not favor a strong trending move based on the structure and the context that we're seeing in the market. So what's going to happen is we're going to get long over here, expecting the market to hit our upper green line up here. We start moving up. We're happy. The market's moving in our favor. We're making tons of money. And then all of a sudden, the market starts dumping. We freak out and we stop out of our position. Guess where we stop out of our position from after that failed rally? We stop out right inside of a demand zone that was the center of this balanced range. The market then temporarily reverses. And guess what we do? We're testing the lower portion of that balance range, which was that lower white line. So instead of maybe taking the market short outside of this balance, maybe wait for a retest, and we could have just capitalized on a quick little sell-off in the market. So structure is important. Always look from right to left and look at the higher time frame structure and lower time frame structure. So always chart from right to left. Looking at this screenshot over here, we see two purple lines, and this is when the market opened up. So ever since the market opened up, we haven't created any structure. The market is just moving down. Then we moved up like a roller coaster, and there's no signs of buyers or sellers. It's safe to say that we're in equilibrium, we're semi-balanced, and there's no real edge to the buy or sell side. Again, put yourself in the shoes of other participants. Think like a retail trader, but don't trade like one. Is there an edge to the up or downside on an intraday basis based off of these purple lines right here at that moment? I personally do not see any. With this in mind, we start from right to left. Now we look at the left side of our chart. On the left side of the chart, we don't see anything. We see an uptrend, putting in higher highs, putting in higher lows. There's no structure. There's no consolidation. There's no area of demand. There's no area of high volume. There's no area of larger liquidity or something indicating that buyers or sellers have an edge. So not only do we have no structure intraday, but we also do not have structure or context from buyers and sellers from the overnight session looking at the left of the chart. What this tells me is I must avoid this setup because there's no structure and there's nothing of valid interest that's going to give me an edge as a trader. Now, what's going to happen is a lot of traders are going to see maybe a low a day break, maybe a wedge break, or maybe a support break or a break of VWAP, and they're going to get short the market. Maybe it works out one time, two times, but consistently following the process and consistently finding results is going to be harder to achieve, and it's going to be slimmer. If we take a low a day break, what's the structure? Where could we target? What's the analysis? And why should we do so? Is it giving us a valid edge where we're trading on the same side as buyers and sellers? And on this chart, I do not see valid structure, so I wouldn't take a trade off of this setup. A lot of retail traders fail at technical analysis because they rely too heavily on indicators. Now, I get tons of messages when I talk about this. If it works for you, ignore what I'm saying. I really don't care. But for me, when I first started out trading, I would have tons of indicators on my charts that looked like this. It never worked for me. It was more noise, and I struggled to find consistency when I had tons of indicators. If you take one thing out of my lessons and one thing out of my videos, price and volume is all you need. Indicators are only good if you can paint a picture and it gives you an edge with definable parameters, such as when we see X and Y and we get Z, then we get a result of a profit or loss. So it helps build a system, but indicators do not physically move the market. If we were to wait for, let's just say, a MACD crossover or the RSI to be oversold, it skews our risk to reward. It gets us in after the market moves and get in with true intention of market buy or market sell orders that get us in with before price moves. Instead, indicators get us in after price moves. I see a lot of retail traders fail with technical analysis. This happened to me as well when I first started out, was I did not implement proper risk management, and I always had a very tight stop loss, not giving the trade enough room to breathe. So my tip of advice is always put your stop loss at an area where analysis is incorrect. Do not put it at a monetary value. Do not put it at a random point just because you think that the market is going to move down or up. Put it at an area that your analysis is incorrect. In this example right here, let's just say we bought Apple above high a day. We're in long over here above 144. Again, I still use support and resistance. I still use it as context. And let's just say we had a target of 145-ish, this green box up here, right? So now we're long. For my analysis to be incorrect in this example, depending on my risk tolerance, would either be below this low that I just highlighted or below this low right here that I'm just highlighting. It depends on your risk tolerance. However, a lot of retail traders, what they will do is they will get in on a strong breakout with momentum. Their option premiums are jacked up because they're getting in after the momentum came in. They're in long up here. 3-4 minutes later, they see the market pull back and they say, oh crap, we're down 80 cents on Apple. My premiums are down 20-30%. I gotta get out of this position. I just checked my P&L. I'm down $500. I just made $500 this whole past week. I can't afford to lose it. They stop out of their position, right? Stop looking at your P&L and start putting your stop loss at an area where your analysis is incorrect. The market's not going to go straight up in your favor, and the market is not going to always move exactly how you want it to. You're going to have roadblocks. You're going to have pullbacks. You're going to have consolidations. If the market did exactly what we wanted it to do every single time, there would not be a market. The only thing that we can do as traders is implement risk management and trade when our strategy tells us to trade. That's it. That's the only thing we could do. A lot of traders are going to stop out on this route, this sell off to the downside. If we had a stop loss below this low, it would have never triggered and it would have kept us in this position and we could have capitalized on a strong rally to the upside. Everybody puts their stop loss at an invalid point. It has to be where your analysis is incorrect. And you adjust your position size to make sure it fits your risk parameters. Don't put a stop loss at a random level just because you're going to be down $500. What that tells me is you're over positioned in that trade. Instead, just size down, adjust your stop loss accordingly so you could afford that loss if you do stop out. Losses are inevitable. You can't avoid them. And a lot of traders take losses. They get in their own head and they freak out because they just took a losing trade and they were wrong. You have to lose and you have to be wrong in order to win in this game. A big reason why retail traders fail is they do not know order flow. Again, price and volume is what moves the market. It's how the market facilitates trade. The market's an auction. So for us to read the orders coming through the market, reading order flow, and knowing what goes on behind the candlesticks, in my opinion, if you are a scalper, it is vital for success. I personally cannot put so much emphasis currently on just candlestick data. What candles tell us is where price is currently and where price has been in the past. You are not going to know the true intention behind buyers and sellers solely looking at a candlestick chart. So it's imperative, especially if you scalp, and 98% of my trades have some type of order flow analysis backing that setup and giving it confirmation for me to buy or sell. When I use order flow, I'm also trading on the right side of participants. I'm not buying when I shouldn't be buying, and I'm not selling when I shouldn't be buying. I'm basically buying on the same side of the trade that I'm looking to put on. We can't see that with a candlestick chart. We can only see where the market is and the candle data that is being represented. We don't know the volume. We don't know how many buy orders, how many sell orders, and we can't read the order flow just by a standard technical analysis chart. For example, if I'm looking to play this bear flag on SPY, the S&P 500, I'm totally cool with using a technical pattern like this, right? But why retail traders struggle is they're not confirming their trade on being the right side of participants. What's stopping the market from breaking this flag? And there is large bids, we spot them on the level 2, right directly below this bear flag, and majority of retail traders are selling right into a large bid. That large bid gets filled, and then the market absolutely reverses to the upside, and our short position, as we're coming up, we stop out and fuel a further rally higher. So it's imperative, in my opinion, based on how I trade, I can only say how I trade, to use some type of order flow analysis, time and sales, level 2. I have been relying heavily on Bookmap. For example, if I'm taking that bear flag rejection, I want to see a lot of aggressive market sell orders come into the market. I want to see offers step in. I don't want to see very thick bids. I want to see very thin bids to the downside, confirming that sellers are present and there's not so much buyers that I could be in a complete trap. This is how you avoid fake outs. A lot of people always ask me, I'm buying a high daybreak or I'm buying a bear flag, wedge, whatever the case may be. As soon as I buy or as soon as I sell, the market reverses on me and it was a complete fake out. How do you avoid fake outs? Understanding order flow, putting the pieces to the puzzle together, understanding the true intentions of buyers and sellers by watching the tape. Any type of relationship between price and volume is the cherry on top of the cake that confirms the trade. And I only look at it to put a setup on once I do my analysis on the charts. A lot of retail traders, or what I call monolithic technical analysis, meaning they are very concrete, they're very set in stone, and they don't really change. They're a statue, they sit there all day, and they don't react, they're not adaptable, they're not flexible, and they do not agree or bend with change. As a trader, especially using technical analysis, you must flip like a switch, rely so much on reacting to what the market provides you, and don't expect something to happen. This market we're seeing right now, and I've made it a key point in a lot of my recent videos, is a very different market than what we've seen 2 weeks ago or a month ago or even a year ago. So you must adapt and change with the market, or else you're going to get left behind and you're going to struggle. Adapt to new ways, try different things out, increase your edge, and do not rely so much on monolithic technical analysis. Don't be so uniform. Be like Play-Doh, right? We can move Play-Doh, we can stretch it, we can bend it, and it'll always be Play-Doh. A lot of people are like rocks. They can't be broken, they can't be bent. They're very uniform, they're very hard-headed, they're not open-minded. You must rely on adaptability and flexibility, and do not rely on monolithic technical analysis, and be vulnerable to change when the market tells you to change. So I'm going to end the video on that note. I hope it helped. I hope you gained some clarity from this. I hope I can make you have an open mind and really stop trading like a retail trader, but start thinking like one. It's a serious edge in itself if we know where retail traders are trading at and we do the opposite, or we know where they're stopping out at, or we know where they're buying or selling at. That's a serious edge in itself. So think like a retail trader, but don't trade like one. And watch the other videos on my channel if you're new here. So I'm ending it. Comment if you have any questions. drop a like on this video. I would really appreciate that. And definitely hit the subscribe button and join the Invest to Trade team. Peace out.